strategist specializing in fractal time series analysis and stochastic modeling. He has been working in the financial markets research area for 10 years, and he's advising macro clients on macro opportunities and associated risks. He's a very strong background in geoscience, economics, and technical analysis, and is going to talk us through the fascinating world of fractal analysis. So please welcome Simon Meltzer.
Well, thank you, Murray, for the introduction, and for the STA for inviting me to speak here today, and to everybody for turning up to see my speech. I was going to say I wasn't going to be as entertaining as Andy Murray, but someone used the Wimbledon line just previously. This presentation will be available on my website as well, so don't worry about writing stuff down, it'll be there. So first things first, disclaimer. Don't sue me if your investments don't work out. It's not my fault. It wasn't me. Right, there it is. This is just how I view the world. This is to share information, show what I do on a daily basis. Quick bio, background in geoscience. I've worked on the National Geographic project, worked in aviation technology launch, interested in financial markets, from back in the 80s when my dad invested me in all these Thatcher schemes and in water and electricity, etc. I guess nowadays it'd probably be in banks. MST qualified in 2004, CFT 2006, traded my own capital since 2001, worked at 2 proprietary futures houses, owner of fractal That's not really a website with much information, it's more just a to get the naming rights. I've operated my own research service since 2008, firstly under simonmeltzer.com and more recently under macrovigilance.com. I try to view the world from a geoscience perspective, using each market and instrument like a wave buoy or a seismic measurement system or a wind station. And then I try and consolidate all the data together to try and get reliable and consistent inferences. I'm a big believer that pending economic storms and market quakes are often forewarned in the data. That sort of visual representation, I try and view the world and look for storms. I try and be independent, proprietary, and always vigilant. I'm based in the south of France, so I've just flown in. But the one thing, I think the advantage sometimes being based out of the city is you kind of have your own space to think and make your own decisions rather than being bombarded by the endless noise that the city creates. Right. Warning, there is no holy grail for analyzing or trading financial markets, but we should understand deeply how they work. The social world is a messy place. 5 minutes of scouring Google, the news, you can see all these images. I mean, we just saw it this weekend with this terrible accident with the oil tank, the tankers going down in America, and stuff is always happening. And so the same kind of things happen in financial markets. Where there's humans involved, lots of humans, lots of decisions, panic, literally chaos. I've taken these 2 pieces from these 2 renowned scientists. I'll let you read them quickly just to sort of show you where I'm coming from. Anywhere, system where human behavior is involved, it's really hard to quantify. It's really hard to solve, as Stephen Hawking says. And then brings me on to Mr. Mandelbrot, who gave us the idea of fractals. Sorry. So what are financial markets? Lots of different definitions. When I'm talking about them, I'm talking about instruments, assets that are traded on an open and regulated marketplace and exchange. Places where give you constant streams of data, not so much sort of black pool, dark pools, those kind of things. It's the bidding up and down a financial instrument or asset, individual people and now machines, more so than ever, interacting to take ownership, make profit and hedge risk. So I've come up with this simple flowchart, if you like. Financial markets, interaction of many participants, both machines and humans. That creates crowd dynamics, which you get group psychology and behavior. From this, you get an emotional, unpredictable behavior. It's an organic, complex, fluctuating system, which essentially is volatility and mathematical chaos. So you watch Bloomberg, CNBC, you rarely, well, they say volatility, but generally they don't really know what they're on about. They don't really talk about mathematical chaos. You hit the news, they say it's chaos, but they don't really understand, I think, what, mathematical chaos, right. That's a quick definition of mathematical chaos. The property of a complex system whose behavior is so unpredictable as to appear random, owing to great sensitivity to small changes in conditions. From this, we end up with respect to financial markets, a system with the following characteristics. Non-linear, not arranged in a straight line, not sequential or straightforward. If there's two things I want you to take away from my speech tonight, is these two things. Financial markets, complex systems are stochastic. And stochastic's often spoken about with the stochastic indicator, but that's another story. Stochastic basically means something that's unpredictable, it moves up and down, it's random. And then the other thing financial markets are, they're fractal. A curve or a geometrical figure, each part of which has the same statistical character as the whole, in which similar patterns recur at progressively smaller scales, and describing partly random or chaotic phenomena such as crystal growth and galaxy formation in financial markets, and so on. So we'll start with stochastic. Lots of processes in life that can be recorded as a time series, basically where you've got time along the bottom, units up the side, a stochastic random up and down movement. I don't know what this is charted is, it's just stochastic. What kind of things do we find as a stochastic process? Oxford United is league position. I'm not picking on Oxford United here, it was just the first one that came up on Google. If you draw a line across there, is that head and shoulders? Maybe, I don't know. We'll carry on. Temperature in London, stochastic, up, down, up, down, up, down, up, down. Very hard to predict. There's periodic cycles where you know it's going to be warmer in the summer, colder in the winter, but to predict day to day, it's stochastic, it's very difficult to do. Economic data, unemployment rate, up, down, up, down. River discharge data, don't worry about the red line, that's just a smoothly moving average. Same kind of thing, stochastic, up, down, up, down. Wind speed, similar kind of thing, up, down, stochastic. So these are all examples of stochastic data which you can record. Wave height, recorded from a buoy, same kind of thing. If you took the scales off and you knew nothing about them, you couldn't tell what scale they were and you couldn't tell what they were, whether they're wind, water, markets. Coin flipping experiment. I was bored one day, so I flipped 1 million coins. Well, no, of course I didn't. But I downloaded it from this source. Mandelbrot speaks about this in his book, and he says, same kind of thing. The idea is you flip a coin, if it's heads, +1, tails, -1. You'd expect in the long run it should revert back to the 0, but you can see at times it goes a long way from the 0 line. This is kind of like an attractor line in chaos. This is the attractor. And it goes a long way the other side. Another 1 million tosses. It looks just the same as a stock chart, a stochastic process. Maybe even relationships could be modeled as a time series. Now this is a bit wacky, but stick with me on this one. Right, so we have the wow moment of meeting in a bar. This is probably more taken from a female's perspective. First date, or he receives a text from a female. She doesn't like that. More great dates and finally sleepovers. First minor argument. Holiday together. Bear in mind, this is time, and this is, if we could measure it, enthusiasm, feel-good factor, happiness. So finally moving together. Argument over domestic nonsense. They get engaged, feeling better. It's going up on the infusement scale. Huge argument over wedding details, etc. Finally, the happy couple get married on a honeymoon. But then the honeymoon period is over. Fun DVD nights on the sofa. He forgets her birthday. Oh, the enthusiasm's going down. Buys her big flowers, showers her with gifts, and weekends away. Then the really ugly head pops its head up. finds out he slept with the secretary, not good. We have a massive down wave. He says he's sorry, she forgives him, makes up sex, etc. More lies discovered, he promises to change, she packs his bag and sends him on his way, divorce finalized. Now, that's a sort of, a theory I put together, but the whole idea is it's stochastic and it's very similar to sentiment in financial markets. I know Robert Precht has mentioned this in his books with relation to the sort of star status of stars. It rises, and it wanes a bit like Michael Jackson and all the skeletons in the closet, and it descends. So just to show something different. So many processes in life and in nature are not simple straight lines. They're not linear. They are jagged, they're complex, they're rough, a kind of balance between chaos and order at the same time. Fractals. So this is the grandfather of fractals, Benoit Mandelbrot. He was a professor at IBM. Fractals come from the Latin fractus, meaning broken or fractured. He said things typically considered to be rough, a mess, or chaotic, like clouds or shorelines. Some of the things I talked about earlier actually had a degree of order. Fractals are typically self-similar patterns, where whatever the scale, the patterns are very similar. They're scale invariant. Also in nature, here are some examples. Lightning is fractal. Trees, river systems, mountains, waves, glaciers, icebergs below, sand dunes, clouds, all these things are fractals. If you didn't know what the scale is and where your perspective was to these things, it'd be very difficult to know their exact size. And so fractals on financial markets. Looks, there's the mountain range, there's the market. Another picture. Don't know what the mountain is, but is it the Matterhorn? Matterhorn, there you go. I'm a geographer, don't ever get me for that one. Again, I just Googled. Right, so the market process can only do one of three things: up, down, sideways. As a up, down, sideways. Price rarely stays equal, as the motivation to profit, position, or hedge creates constant flux. From any point in time, price has the potential to take many different courses. So take any point in time on the stock market or in the FTSE in the day, it could do many things. So many things influence, it's a complex system. So we can define it as a random walk. I'm not going to go into random walks. There's different random walks, there's different definitions, etc. I put a bit at the bottom. If you want to see more about that, you can look on the slide. So prices can also gap down. This can happen intraday, after a trading halt, overnight, weekends, market holidays, places on the price scale where no trading actually happens. Think big events, information shocks. September 11th, the market closed. It never opened on the US market, I don't think, or did it slightly open? But then it stayed shut for 3 or 4 days, gap down. Price expansion. So this is another thing I want to really push the point. Price expansion, price is always expanding, up, down, sideways. That's just dots plotted of where the prices are. So this constant expansion, contraction, expansion, contraction, expansion, contraction of price. Or in another way, progress, regress, progress, regress, progress, regress. Financial markets are a bit like a game of snakes and ladders, with the board continually evolving to the right with time, up, down, up, down. Think in terms of triangles, not the traditional technical analysis triangles that we see in the books that are more horizontal based, but think of triangles of low, high, low. There's always low, high, low, high. So triangles, the market is just constantly creating triangles of all sizes. That's the fractal nature of it. You can progressively see smaller triangles. The market's constant progress and regress behavior, that is stochastic by nature, creates this high-low, high triangulation. So we've got this one cycle with low, high, low, but within that we've got this lots of smaller low, high, low fractal triangulation happening. That's a quick definition of triangulation, formation of or division into triangles. So that's essentially what the financial markets are. They're the formation of or division into triangles, fractal triangles. This process creates fractal cycles. So this is a bigger cycle, and then you've got smaller cycles. Even though that's a big up leg, there's still a triangle there, low, high, low. This process in many ways can be explained by the ideas of George Soros and his general theory of reflexivity, as shown below in the boom-bust cycle, which is popular in his book. I won't go into it too much, but essentially you get positive feedback loops that propels the market up until a point where that positive feedback system doesn't work anymore, and then on the other side you get the negative feedback and back down to a low. And in a way you kind of get that in every day on small scales, medium scales, all the way up. The triangle sort of positive sentiment, positive sentiment, negative sentiment. So this high-low process happens in all time cycles. This is tick data from the S&P 500 futures. What time are we here? It's happening very quickly. Triangles between the bidding and the bid and the ask. Up, down, up, down, up, down. 3-second data. Don't worry about the volatility bands. Triangles, triangles, triangles. 30-second data. Each T represents a low or a high. If you join any ones up, you get triangles. If you join that one, and that one, you get a bigger triangle. And you can progressively obviously go lower or higher in time scale for these geometric triangles. S&P hourly data, the triangles again. Macro triangulation. This is the Nikkei over 20 plus years. There's the great bubble of the last day of the 80s. High, low, high, low, high, low. The market just constantly creates this stochastic triangle formulation. A few more examples. These from the same day. This was a intraday Coca-Cola. It doesn't happen like this every day, but the triangles are very obvious there. On the same day, IBM intraday, triangles, triangles, triangles. McDonald's, same day, triangles. Days like this are a lot easier to trade than days where it's sort of whipsaw and then up. Essentially, markets have a triangle within a triangle within a triangle and so on structure. I've used the Sierpinski triangle with a superimposed price or stochastic process, and that sort of describes how financial market works to an extent. This was the expansion contraction one I showed you earlier, or the progress regress, and that was the actual section there, and all I've done is just up the scale. So that bit is the same as that bit, and the bit is the same as that bit, and all the small parts become part of the larger, and that's what financial markets essentially are. I'm going to just introduce the fractal market hypothesis, which is a hypothesis proposed by Edgar Peters. Markets consist of various layers of traders and investors who participate at their chosen timescales. It's a bit like a trophic pyramid in biology. You've got a few second scalpers, 5-minute traders, for example, several hours traders, overnighters, swing traders, multi-month traders, all the way down to our long-term multi-year investors. The market is, part of his hypothesis is the market is stable when it consists of both machines and humans covering a large number of investment horizons, which ensures there is ample liquidity. Where one person doesn't step in, just below it someone else will step in. Market sentiment and technical factors are more important in the short term than in the long term. As investment horizons increase, longer term fundamental information dominates. Markets become unstable when the fractal structure breaks down, as investors and traders and machines at various different time horizons behave erratically. For example, when there's massive news, they don't know, what do I do, what do they do? They start panicking, they start pressing buttons, fat finger trades happen, and then they try and reverse it and double down, and all things happen. It's when these people start behaving erratically or stop participating altogether. If you take out layers of traders and they say, right, I'm not trading today, the market, I can't work it out, suddenly you get this fractal breakdown. And this is what we saw on the flash crash of May 2010. The SEC in America, Security Exchange Commission, have done a big investigation, and they reckon it started with a fat finger trade. But this shows the market depth. You can think of these all the sort of, this is obviously the bids and the offers, and these are all the different trophic layers of people that are willing to buy or sell at different levels of the market. And as you can see, as we approach this area, those trophic layers of investors, traders, people willing to be a buyer or a seller, it starts shrinking on both sides, and liquidity dries up, and suddenly the market plunges. And then it takes time for people to re-enter back into the market, and eventually those trophic layers start filling out again. More on triangulation. We all know what this pattern is. Just to show the point, head and shoulders, there's a triangle on the left shoulder, the head, and the right shoulder. It's progressively got smaller triangles if we wanted to go deeper and deeper, but just to send the point home on the most famous technical analysis pattern, that it's triangles. For anybody who you speak to, if you're a technician, and I've been in these situations many times, sometimes in speaking to hedge fund managers who run billions, or I don't know, the validity of technical analysis, just show them this chart. This is the NYSE Composite Index, essentially the world's largest stock exchange, 2006, and it's the best head and shoulders pattern the gods ever gave us. What happened? The biggest deflation in company valuations for corporate America. And the pattern, it showed it. Now I want to talk about non-traditional patterns and ratios. Have many people heard of Larry Pesavento? Anybody? Yeah? Show of hands quickly. So yeah, probably about 20%. So, and you've read this book, so you'll be familiar. So I'm a big proponent of his work. A lot of my work has come from him, and so I pay big homage to him. So I'm just going to talk about 3 of the patterns quickly, because it's all about triangles as well. The Gartley pattern, the butterfly pattern, the 3 drives pattern. The bullish Gartley pattern. I haven't labeled them. He labels them with A, B, C, D. Essentially, it's a sort of 2 triangle structure, and then an up, and then you just tip the pattern on its head, and it's a bearish pattern. Let's go to an example. Here we are, Eurobond on a an hourly chart. We've got a big mark down, a mark up, a mark down, and this is where our sort of trigger for a sell is on a bearish pattern. I am a big proponent of using high Kanashi charts. I think they're quite good at, to try and get more disciplined of waiting for the signal. Nothing's perfect, they don't always work, but that's what I've used on this chart. Now, you can add ratios. Ratios like Fibonacci ratios, expansion, both expansion and retracement. Here the market has come down and it recovers, sorry I can't really see the light there, 61%, and you've got this expansion of this triangle, which is 127%. 127% is, or 1.27 is basically the square root of 1.618. That's how we arrived at. And you see 127% expansion all the times on all time frames. I don't know if it's a self-fulfilling prophecy thing or if that's, I haven't done that much research into that, but it seems to happen a lot. And when you get a cluster of 2 things, often it's a very powerful trading signal. The Dow Jones Industrial Average on a weekly basis, this is going back to 72. This was a bullish pattern. The market went up, corrected, went up, corrected, and then it went up massively. And this was largely before computers and there was all this technical analysis software that we all use was available. It's just to show that this kind of stuff was still happening back in the day. There's the retracement percentage ratios, 50% retracement, which coincided near a 161 and a 127. Bearish butterfly pattern. This is the next pattern. Where this pattern is different is the signal is higher up. Just to put it into perspective, it's kind of, there we are. Shows the sort of why it's called a butterfly pattern. The S&P 500 index created a butterfly pattern on its low in March 2009, essentially the end of the last bear market. There's the pattern. I'll put the ratios on. It's the same chart, it's just it was taken from previous work I had done. This triangle here is 127% expansion, or a negative expansion, decline, and this triangle here was a 261, and it pretty much happened within a couple of points. I'm not trying to, claim I knew this was happening, but I remember sending an email of the day with this chart to a boss at one of the future houses I was working at, saying, "Is this possibly the low?" You never know until after the event, but I should have put the email on that, but you'll have to trust me on that one. And it was just on that simple triangulation with the ratios. Another factor for this low was the commitment of traders' data. That's another story for all to talk about it, but essentially you've got commercials, large traders and small speculators. You can think of the small speculators as the retail traders, large traders as hedge funds. The commercials are the big players, the smart money. This low, if you look at the commercials, by the time we got to this low, they really upped their buying of S&P contracts. That was just another confirming factor that maybe there was this butterfly pattern was going to work.
That's the large traders, not the commercial.
Sorry, was that the... You are very right. You're right. There was yeah, completely right. There was an uptick as well on the commercials as well, but it doesn't look as significant as the large traders. Another butterfly pattern, US dollar index in 1992. I haven't got the ratios on this, I don't think, but essentially I just want to send home the butterfly pattern. Hopefully, if you haven't heard about these patterns, you might start seeing them and think, is that a butterfly pattern or is it a Gartley pattern? There is an element of subjectivity to it, but it's just another way of looking at the market. This was a bearish butterfly on BlackRock World Mining Trust. I remember the market at the time going up, and I was thinking, everybody's so keen on resources and metals and mining, but there's a butterfly pattern. What does this mean? I wasn't aggressive like I should have been with it. I didn't trust it enough, but as it turned out, it was a very powerful signal. There's the ratios installed. And I always sometimes you have to have a bit of subjectiveness or subjective analysis of where you take the count from. Do you take it from the top of the candle, the spike, or do you take it from on a regular candlestick? Do you take it from just use open and closes? Sometimes you have to play around the two. It's not an exact science. So anyway, going back to this, we had 127 expansion from there to there, and we had a small 127 there. I've got the triangles on another graph at the time I did. You had 3 triangles all saying this is potentially a powerful butterfly pattern. Oh, there's Oxford United again. Is that a butterfly or am I just being fooled by randomness? I don't know. But anyway, there we go. The final pattern that I'm going to talk about is the 3 drives to a bottom pattern. 1, 2, and 3, or alternatively 3 drives to the top. 1 push higher, 2 push higher, 3 push higher. This is very similar to the ending diagonal in Elliott wave theory. 1, 2, 3 for the 3 peaks to a top. So Eurostop Bank's example, 2007, 1 push high, 2 push high, 3 push high. Potentially a powerful signal. There's the ratios on it. I won't go on to those. You can view the slides afterwards if you want to go. But this is just to sort of support the ratio analysis if you want to do it. 3 drives to the bottom for the S&P Global 1200, which was happening at the same time as that butterfly pattern that I showed you on the S&P 500. Knowing all these patterns can give you more confidence that maybe you are making the right call for yourself, your clients, etc. I've put the ratios on, won't stick there. So summary so far, markets are chaotic, non-linear, and frequently prone to turbulence and shocks. But a fractal beauty is at the heart of it all, essentially jagged lightning bolt patterns and triangle patterns. So how can we model such behavior? Analytical philosophy is what avoid creating tube maps. I won't say whose chart this was, but it looks a bit like a tube map. It's a bit hard to see what's happening there. Analytical philosophy, follow the empirical data, not the opinions of the talking heads and the narratives. Make things as simple as possible, but no simpler. Be concise and to the point wherever possible, relying on data to validate. Have a robust fractal model that you understand deeply, both in strengths and weaknesses, that you can apply to any time frame scale that results in consistent inference. So essentially that is, if you set up, I'm not so much talking about the ratios, I'm more talking about using statistical tools like moving averages, that kind of thing. Find something that you know is reliable and you can apply to any time frame, whether it's a 1-minute chart, 5-minute chart, 10-minute chart, hourly, daily, and it will give you a consistent inference. It will tell you more times than not that you should be following what the chart's saying, what the model's saying. So I've created my own proprietary model. This is run on, these are hourly, German Bund, and natural gas. Essentially, when it's black, it's bearish. Essentially, when it's green, it's bullish. These two, NASDAQ daily, there's the big NASDAQ bubble, and crude oil 5-minute chart. So it's the same model, it's the same volatility bands, moving averages. Just change the instrument and the time frame. So essentially, black, bearish, green, bullish. But obviously, there's pockets of green in here, and there's pockets of black. So that tells you then go to smaller time frames and try and get on the right side. Potential pitfalls to avoid: the analyst's bias, analytical arrogance, the prediction problem. All stochastic processes are inherently unpredictable. So if someone says it's a sure thing, always question it. Extrapolation. Again, markets are not linear, so it's very dangerous to extrapolate on an existing trend or line. Things can change very suddenly, very quickly. Trying to masquerade as a profit, the guru trap. Be wary of the most used words in the financial world, I and think. It's probably the 2 things you hear all the time on Bloomberg, CNBC, I think. Well, I suppose they are after opinion, so I can't really fault that, but always question it. Always ask yourself, am I being fooled by randomness? Am I seeing the pattern? Does it mean anything? Etc. This is just my own philosophy. It's not about prediction. It's about positioning for potential profit and managing the downside at all times. Price behavior represents the collective perception of everybody. The system knows vastly more than any individual. Just stick to the empirical data and keep things simple. Right, this is another point I really want to send home. Think in terms of wholesale and resale. Wholesale is where smart people get on board, get involved in the trends. the other side is where retail people get involved. So this is a sort of volatility band, sorry, Bollinger Bands with a moving average. You want to be looking to sell when the thing's obviously going down, but in these areas, when the model turns bullish, be buying it on this side. Don't be buying it up here, because it very likely will come back, and it'll be quite painful to experience until it goes up again. So wholesale, retail, wholesale, retail. That's with the price data on. So for example, this is an intraday chart. I'd be looking to sell there, sell this triangle, buy this triangle. And then obviously when you go through sideways period, it then becomes more difficult. But essentially still want to be a seller there, buy there, etc. You just, by having this mentality of wholesale, retail, it's hopefully getting you a better entry price. In the Dow Jones, another example of the recent move. This was the best wholesale entry that this model showed. After the 2007 problems, that gave a sell there. Right, moving on. That's the crash of 1987. Sorry, rapidly falling out of time here. There's the euro. I want to push on because I've got a few more things to tell. Don't be selling it down here. That's when the smart money's buying it. Don't be buying it up here. That's when the smart money's selling it. The colour, gives you if it's bullish, bearish. Real-world modelling of financial time series data. How do I model at macro vigilance? I'm global macro, so I stick to weekly data. I believe this is the optimum timescale for making macro calls. Daily's too noisy, monthly's too lagging, weekly's just about right. It's all about searching for the signals amongst the vast amounts of noise and chaos. Primary efforts, fractal time series analysis, statistical applications to market data. That goes back to my fractal model that I have. It's proprietary, so I haven't put all the numbers on, but you have to make your own. Intermarket relativity analysis, proprietary volatility work, incorporate big picture economics. So methodology, closer up quickly. Fractal triangulation, price expansion, contraction. Always be thinking, is the market in the expansion phase or the contraction phase, the progress and the regress. Same data, look for traditional patterns as well. I still use traditional technical analysis patterns. I showed the head and shoulders pattern of the 2008 crisis. Always be looking for those kind of things, but also be looking for alternative patterns. This is the same example as before. When it's blue, it's nice uptrendy, but shudders of red make me think, is this market, going to be going down soon? Heikin-Ashi charts, these are giving me my signals. Methodology, I also use candle volume. I think candle volume is quite powerful. This is Facebook. Remember Facebook, when they were coming out, lots of people saying $40, I think it marketed at. Lots of people saying it will go higher. Lots of people saying it's overpriced. Just what's the data telling us? Disastrous first day on huge volume. Second day, looking for shorts. I would also, obviously then, I couldn't really apply the fractal model to this because there wasn't enough data. You could obviously on 5-minute charts, but you can't on the daily chart. This is a daily chart. I'd obviously look at Heikin-Ashi charts and the percentage ratios as well. That's just to show how I use candle volume. Look at all markets together, intermarket relativity. Every instrument is connected to the wider asset universe, yet some outperform and some underperform. Knowing where to position and what point in time is the key to superior portfolio returns. Just gives a few examples. Obviously don't be in Greece at this time, and be in the sort of more stable economies and stock markets. Proprietary work on volatility. This is my macro fractal cycle. Obviously this hadn't completed when I applied my model, but I can see from this model the volatility is dropping off. It's stable, but then suddenly you get spikes. So, and as you get this stair-stepping of volatility spikes, it raises the the warning, the risk warning. And I start, you have to consider to your clients, where should they be positioned? Also know and understand what's happening with the economic big picture, central bank stance on money supply, interest rates, inflation, deflation, exchange rates, commodity, energy prices, demographics. For example, know if an economy and a stock market is in deflation like Japan or in inflation environment like USA. This is an up-to-date chart. There's been a bit of inflationary spike recently in the Nikkei. Incorporate relevant economic data models. I'm a big fan of this model, which is by the St. Louis Fed. You can go on Fred or type St. Louis into the internet. This is a model on the economy and banking. Stable, a bit like the volatility I was just talking about on that chart. And I incorporate this in my monthly work. We've had a little spike recently, but basically it's extra evidence. Is the banking and financial sector and the wider economy stable, or is it gyrating towards more risk? This intermarket analysis, again, same model run across different markets. Sorry, S&P, sorry, I can't really see here. I should know them, I don't know them all. S&P, sorry?
Top left according to what
Top left, yeah, S&P.
Top rows you like.
Yeah, sorry, NASDAQ. Same model, and often they're giving you the same signals at very similar times, so this can be powerful. Closer up, the S&P, this is an example of how I use the triangles. We had a big retracement, larger 38% retracement, short-term 78% retracement, low, high, low. It was in the buy. It was near the sort of the buy zone on my model. Intermarket picture looked good, as I just showed you. Monetary supply expansion and QE program supportive of further equity gains. This is same model that I showed you before, run on government bonds, German bond, German bubble. Often showing on the same model run across different markets, showing buy points, sell points, etc. US banks, same model, all the same model run across the same things. Just looking at the intermarket picture, if one thing's saying sell and the other ones aren't, it's not a very powerful signal in my view. If they're all saying sell or buy at the same time, there's a lot more weight behind that. This is an example of fractal triangulation on the daily, on the euro US dollar. I won't go into these too much because you can look at them on your own time. This is another way I model a company against the FTSE. This is the model. You had the FTSE outperforming Diageo I've used here, and then 2011 when we experienced that 15% or so decline on the FTSE, Diageo starts outperforming. And again, this is the spread between the two. I'm looking on. I want to get involved on the whole side. I don't want to be buying Diageo up here. I want to be looking to get involved on the wholesale side of things. Using commitment trader data again on sugar. Sugar has been very powerful signal with the COT data. When the commercials after an extensive period of buying more contracts, there's often a low in the market on a triangle low and an up move. This is the same model, all the same models that I've showed you before, but run on DAX future. This is a couple of weeks ago. Obviously we've got this bullish, and then we have high, low, high, and then as the red starts to appear, I'm looking for sell signals in the wholesale zone, and looking for the first Heikin-Ashi red bar that will give me a sell signal. This is it with. I'm also looking same model, but with candle volume. So I'm looking for traditional candlestick patterns, engulfing patterns with candle volume. Then I'll go down to 5 minute. Have I just gone back? Yeah, 5 minute chart. Again, then I'm looking for the wholesale sell on the 5 minute. Everything's got to be aligned. not a new concept. Lots of people talk about that, but this is how I look at it. This is a bit further what happened. Obviously, more triangles down, lots of sell points. Similar picture, intermarket analysis. This was the same sort of time period on the Swiss future and then on the Eurostoxx future. Wholesale area looking for sells. So a quick discussion on 100% systematic versus semi-systematic, discretionary. I kind of class myself as somewhere between discretionary and semi-systematic, probably a bit more semi-systematic. I think 100% systematic is very good for machines and single markets, intraday stuff. Semi-systematic is what is more suited to my type of thing because there's many variables. It's very hard to quantify all these markets in one model without some kind of human interaction. Similar to weather forecasting, they still look at satellite images and take wind data, and there still has to be a lot of human judgment involved. Discretionary can obviously work, but good market instinct and discipline is required. Current global macro data, just have a final wrap-up of things. This is the same model run across a few markets. The global 1200, still in an uptrend, still looking good. There is a lot of room for it to come down, but it's nowhere near in a bear market. The monetary policies and the continuous printing of money supports that. I wouldn't want to be buying it at the moment. I'd want to be buying it in these areas, but the global recovery is still well intact. It's better in countries like America. S&P's made new highs, still looking good. This is I haven't talked about this before. I have a second set of volatility bands for the shorter term. They're more giving me some information on what's happening in the short term. Same. All right, I saw this on marketwatch.com a few weeks ago, and I thought, it looks quite interesting. The triangles, the macro triangles. The guy, I think, was calling for, we're going to be going into a bear market soon. But is this too obvious? Is this too obvious? I don't know. There's my other model run across it with the volatility. Volatility is obviously greater in recent years than it was pre-crisis, but the market's still in a lovely uptrend. I'm still looking for it to come back into the wholesale area, and I think it will find a lot of support there, unless there's some kind of massive catastrophe, like a nuclear bomb goes off in the city. That stuff you can't predict. Just stick to the models. Hopefully they lead you in the right direction. S&P financial sector, this supports the S&P 500 chart, the global chart, I think, as well. It's looking positive, it's going up. Dow transports, new highs, still looking positive. Obviously, there's a lot of potential for mean reversion, but positive for now. NASDAQ, slowly creeping its way up, despite Apple getting slaughtered in recent months. The picture's still very positive. DAX, still positive, still obviously room for mean reversion. This is where the chart that sort of worries me about Europe, the banks, the European banks, still in the downtrend. That has still got to be resolved. There's lots of problems with the banks. It's on the news every day. That chart's always worth keeping an eye on. So I'm not looking to put people into banks at this point. Obviously there'll be a low at some point. I don't think at the moment. The FTSE is doing well. It's not doing as well as the American markets on new nominal terms, but it's still up there. It's a good safe haven. China, this is the other chart that worries me. I mean, I know there was a massive bubble, so maybe you have to take that into account, but it's still going sideways in the market. Gold, obviously, it's come off a bit. So, I mean, you hear lots of stuff about gold every day on the, and then the financial media. At this point, I start when obviously a lovely uptrend, a multi-year uptrend. When the model starts going red, I'm start thinking, well, it's still blue. But when you start, the blue stops and it goes grey and the red continues. You start thinking, and then on the shorter time frames, it's more evidence that it's weakening. It's weakening. An up-to-date COT chart. It looks like there is more commercial hedges getting involved now, though. So I wouldn't be looking to short now, really. I think you've missed the train. I think at some level, a lot of people are going to come in because there's commercial hedges buying contracts, or miners who've got to hedge their forward production, etc., etc. 10-year Treasury note. It's come off in recent weeks, potentially near a buy zone on my model. Again, this is a bit inconclusive on the COT data. It's a bit inconclusive, but I just put that in. One of my final charts, I just want to show you. You hear about people talking about the bond market. Has it reached a higher interest rate's going to go up? I don't know. But after the Great Depression, the market went down for multi-decades, and it went along sideways for 15 or 20 years before interest rates in yields started going up again. And if you take into account Japan, what's been happening there, this isn't completely up to date, but it shows many, many years of just going sideways. And this is my conviction on the American market. I think interest rates will do that for a long time. Don't bet against the Fed. Well worth a read. Can I just show of hands, just for my own sort of information, how many people have read this book? This one? And this one, you sir. Yeah, there's all books I recommend reading. I'm a big fan of Nassim Taleb for just philosophy, economics, things worldly, very good writer, worthy of a Nobel Prize, but I don't think he'd accept it. And this is another book recently come out by Nate Silver, The Signal and the Noise. I think it's very good as well. It talks all about forecasting, statistical techniques. That's it, folks.